Sunday. Still happy Father's Day out there for all the dads, would-be dads, maybe just people enjoying a good Sunday. You're watching Taste Live. This is First Call. I'm Chris Vecchio. He's Ilya Spivak. Ilya, how was your Father's Day?
So far, so good. There were boxes of pastries and coffee that I didn't have to make this morning. That's a decent start. How about yours?
That's usually how it works. It's like, just make sure I don't have to do anything today. As opposed
Yes.
to everything else every other day.
Right. Right. Yeah. The children are mysteriously at a playground, and I am not with them uncharacteristically. One day a year.
Today was nice. Today was nice and relaxing. Everyone slept in. The baby even decided to sleep in today, so everyone slept in until like 8:30, which is delightful.
They got the memo across. Very nice.
Yeah. Luke was really giving it what was needed today. So everyone slept in, which was nice, relaxing day. Beautiful weather here still. New York has had, it's crazy. I read a study recently, like since COVID, basically like half of the weekends, 50% of the time it's rained in New York in the weekends from May through September. And that's an uptick from somewhere in the neighborhood of like 34, 35% pre-COVID. Not sure what changed. But since the Knicks won, it hasn't rained at all here in New York. And I don't know if there's any correlation there, Ellie. I know you're our statistics expert on my small sample sizes here, but
this is how the great and powerful folk tales of the world come together.
Ilya, the weekend was riddled with news about what's happening in Iran or not happening in Iran, or what's happening in Switzerland, or who's missing out on various media, press conference, photo ops in Switzerland. It's just a whole... I think the Iran war, the biggest beneficiary has been the news media, quite frankly. Because that's all you're forced to do. You're just forced to tune in, forced to watch. The Strait of Hormuz is effectively closed again, I think, is where we're starting. And as we get to this market open in a few minutes, you can kind of throw away Friday's price action to a certain extent, insofar as the weekend's news have upended the very fragile ceasefire, if that's what we want to call it. Israel took the liberty of bombing southern Lebanon again, which Iran has used as an opportunity to say then the ceasefire is off, the straits are closed. We're looking at an open here, Ilya, where oil is going to be up around 3.5%, maybe 4%, according to Weekend Oil. The CFD is available with our parent company overseas, not here with us in the U.S., but the CFDs through IG, Weekend Oil. You can see that stocks are likely to open a touch lower, maybe 0.3% there on the weekend Wall Street. Gold still pressure, the dollar a bit firmer. Ilya, how quick is the market going to try to shrug this off, given its penchant for shrugging off the news as it pertains to Iran at this juncture?
I mean, the statement out of the president after the talks in Switzerland were apparently diverted suggests that we're kind of back to where we were. The president saying Iran must immediately stop their highly paid proxies, all in caps, in Lebanon from causing trouble. If they don't, we'll hit Iran very hard again, just like we did last week, only harder. Strait of Hormuz was going to be open any day now, and apparently was open as of Friday, not today.
Some tankers got through. And so I think what this tells us is, first of all, as ceasefires go, so too do negotiations about new ceasefires. Because again, this was going to be a 60-day sort of period where we were going to talk about what kind of a deal could be had. So this thing with the reopening of Hormuz last week was an agreement to talk about an agreement. It wasn't an agreement in its own right. And so we're going to probably have a lot of back and forth here. I actually don't think that this escalation is a really big risk-off catalyst, and I think the markets are probably of the same mind, because you really don't see anything too panicky, because it seems like both sides are jostling for position and trying really to find leverage, but both of them want out of this thing. And so we do get a gap
that's
lower
the larger
here.
question.
We got a gap lower here on the back of the
We
weekend
do.
news. However, so modest for what it's
Modest,
worth. 24 points or so, we'll call it here in the S&P 500. Friday, of course, was a day where the markets were closed for Juneteenth. So while you see some, light trading that's going on, technically half day for futures. Okay, so 75.43. Where's volatility, though, at the start of the week? I think that's ultimately what we care about most here, Ilya. 1866, up 17 cents. That's been one of the tells in recent days, right? Even on these days where the markets come down, volatility just really hasn't gotten back out of bed after creeping back up into the 20s. And so while we're starting this week with a VIX futures right now, volatility futures in the July expiry sitting up, 20, 21 cents or so, it's not like you're seeing a huge gap and run away here on either end with equities or vol. So maybe this is just like another war weekend Sunday where we gap open lower, and Monday we could be looking at a green candle.
Yeah, I don't think what you see from the markets here is the kind of response that suggests this was some sort of a catastrophic rupture. I think the markets are seemingly responding. And again, this is very low liquidity here. The news hasn't been good. I think the kind of modest response here suggests the markets are reading this as negotiating language from both sides. That's probably to be expected. We talked about this on last call on Friday about the idea that last time that there was a nuclear deal with Iran, it took years to negotiate. And this deal getting done in 60 days on ostensibly terms that are better for Iran probably was going to be a long shot. It's probably going to take longer. And that basically puts us back largely to where we were at a kind of starting line here at the beginning of the year, where tensions were starting to ratchet up. Let's not forget crude oil started rising in January, well before the missiles started to fly, because
oil,
the pressure started to build.
2.4%, $1.86 here at the start of the week, back to 77.67 in the CLQ6 contract. Modest rise. Place where, by the way, if you were looking for support in the oil market last week, you're seeing a little bit of a turn at that April 17th low. We got to the low during the last big ceasefire announcement, and the market decided we've had enough. 25% off the high is enough for now.
Yeah, no, I'm looking to be a buyer here. I was already sniffing around this on Thursday last week because it started to show signs of what could be a turn. I didn't get my entry ultimately because the risk reward didn't look good, but I'm going to be poking around here over the course of today and tomorrow, sort of go Sunday into Monday's session, and see if I can find something here that's an attractive vertical. So far, the pricing, at least last week, didn't really offer the kind of risk reward that I want, but I think this could be a place where crude oil starts to become an attractive buy again, because we're not going anywhere fast. Even if this thing held and the Strait of Hormuz was open, we're talking months and quarters before anything material actually changes.
Yeah, that's been the underpinning of some of the longer dated activity that you and I both have had on the board recently, Ilya, which is to say that getting back to the pre-war lows, given the tank levels and the inventory levels, and it probabilistically, it seems low right now. I'm curious to see where volatility comes in, because you have to wait for about 15 minutes for the oil vol IVRs to update here. And we were sliding into the end of last week, only 26.6 IVR on the screen there. And so it wouldn't shock me if there's a little bit more vol that comes into play here right now. But given the fact that mediators are still holding court with both sides right now in Switzerland, the meetings, they're ongoing.
Yes. Theoretically.
In theory, how much fear are you going to bake into the market as long as you know people are still talking? To me, it's difficult to get too far over the skis here. So if you get a little bit of a bounce, like let's say we get back to 80, 82, as long as they're still talking, it's probably going to be another opportunity. I'd actually like to see a rally here a little bit, maybe to get an opportunity to sell off some call spreads above that right shoulder near 92, 93. But that's definitely one way I'm thinking about the market this week, getting a little bit of a short, maybe a new short put spread as we're starting to cover the turn here. I'd like to see a move through the 1 week moving average. Give us that. And then we could talk about this being a more durable low between 73 and 74, and we could start trading around it through short put spreads, waiting for a little bit of a zigzag back to the top side right now. And Ilya, I mean, even if we get a zigzag back to the top side, what are the odds we're going back to 120 again, unless the straight really is fully closed through the period when we start to hit tank bottoms? Right now, we got to work with the information that we have. Volatility, let's see where it prints when the market reopens. But Ilya, I want to get away from oil here for a quick second, because this weekend isn't just about the Iran war. There's obviously stuff going on in the currency markets with Keir Starmer potentially resigning. At least that's what Donald Trump is telling the world. I want to bring our attention to equity markets, though, because last week we had another meaningful move higher in stocks, particularly on the semiconductor front. And we do have a major litmus test coming up around the corner. Semis did close at an all-time high last week, 9.88 or $659.88, as humans usually say that. This week we have Micron coming up on Wednesday as the most important earnings release of anything this week, unless you really care about FedEx. Although FedEx and Darden are good indicators for broader economic health, both in terms of shipping for FedEx and then the U.S. consumer. Darden is a restaurant conglomerate. But Wednesday's Micron, Ilya, and that's the one that everyone's been paying attention to here, and not for nothing. I mean, we see it on our end as well. We put up something about Bitcoin on our YouTube page. It gets like 6 likes, and I'm pretty sure 5 of them are like my mom. When we put up something about Micron, it gets like 15,000 views. And so this is really just, we can see what people are paying attention to based on the content that we're putting out and some of the segments that we're putting together here. So this stock now is entering earnings at 1133.99, a new all-time closing high as well. IVRs are near the top of the range, 93.3, 93rd percentile. Is it still insane to step in front of some of these semiconductors right now if you want to, even if you think that they're overvalued?
I don't really see a reason to want to do that. I think these are relatively, it's hero ball. These are relatively illiquid names. They can rally in your face without a whole lot of volume. Why would you want to get in front of a hype cycle? I don't think you would. At the same time, I don't think you'd want to be a buyer. I think if you're going to fade this thing, and I make no secret of being sympathetic to that kind of an idea, I think you do it through the indexes. Because I think if you're going to get some sort of a shakeout, then it's going to be one of these correlation one type setups across markets where it doesn't matter what you're short. But needless to say, if there is a sell-off and it happens without the semis, it's not a sell-off that has legs, because that's where almost all of it sits.
I think that is just put underscore it, cross the T, dot the I. That's the whole game plan for this week. If you want to be and if you want to be a NASDAQ bear, very specific. Yeah. There's this dispersion that we're seeing in the marketplace where you're getting relatively little movement at the headline index, but the realized vol and the actual trading ranges that you're seeing for the median single stock are much wider right now. Mm-hmm. Okay. I mean, you're making a very important point here. If the names that have built this rally under the surface for the NASDAQ are still churning to the upside while everything else is falling apart, you're going to get this choppy NASDAQ that may not go anywhere. Yeah. And so if you're looking for action, you may want to go away from triple Qs and into something that's sectoral. Yeah. Is one of the points here. Because if you're not trading semis to the upside right now, then getting the NASDAQ to break down is a tall task.
It is a tall task. Now, I do think that we're going to get some sort of a sell-off here, or at the very least, I think to trade for some sort of sell-off is the risk-reward bet that makes more sense.
Well,
but in
does
the
it have
index,
to be this week?
But
does
in
it have
the
to be
index,
this week?
It doesn't. It doesn't have to be this week.
Got some things going on.
I've got exposure that's older than this week, and that doesn't expire this week. So for me, this week is less specific, as it were, less critical in my setup. So the shorts that I have on here, and I'm again doing them by selling call verticals in the NASDAQ. I've been in it for 37 days, and I've got 40 days to go. I'm in no kind of hurt.
if semis are going to do what I think they're doing here, which is one of the reasons why I was adding in longs last week, Ilya, we had this nice little bullish falling wedge. We got our breakout to the former swing level. As one typically looks for in a bullish falling wedge, you get a return to the base, which we did. That's when the market stalled a bit and then pulled back. But when we pulled back, what did we pull back to? The former swing highs, turn resistance, become support. And then we swing up into a new high. So this looks like a simple extension here coming out of this bullish falling wedge. And that gives us a 713 price target in SMH. And so if that's kind of like the growth engine right now, this entire market, as far as I'm concerned. When I'm looking at what's happening in some of these, what sectors really matter here for the market, XLK looks like maybe it's getting ready for another swing to the upside following semis. And XLK really has been lagging semis this year. Semis lead, then the rest of tech follows as kind of a second order, third order effect kind of trade. But that there are little pieces right now where this is a pretty crummy week. We talked on Friday how the seasonality right now isn't fantastic. This is the June swoon period, as Ryan Detrick over at Carson Research has labeled it in one of his recent research pieces there, which makes sense. June 18th through June 26th, the market has historically, since 1950, erased all of the gains in the S&P 500 that is put on the board through the first half, a little bit more than that, half plus of the month here. But it's Micron or bust.
And take a look at the, even in SMH, take a look at the momentum indicators, and you do see fading. So could you have a turn this week? Of course you could.
Never once it bothered me.
Well, sure, but it's one of two things, right? When you see momentum diverging like this, it means one of two things. Either you were digesting and now you're coming out of that digestion. That is not what this looks like because you're setting higher highs already. But maybe the period preceding is what sort of rebased you. So I suppose you could say, okay, from the beginning of June and for the past 2 weeks, SMH was in consolidation mode. It finally broke out on Friday. Okay, maybe. But the other sort of way that this works, this momentum diverging like this, is if you're into a top. And we'll see. But you certainly have a chart set up here where you look at it and you go, okay, so fading volumes, right? Fading momentum, right? And you're not in a consolidation anymore. Now you're trying for higher highs. So we'll see, but from the looks of it, this could very well be the run up into a top or a consolidation that's already ended. We're going to have to find out.
I don't use those indicators that way at all, for what it's worth. I
actually only use them that way. I don't really believe in the concepts of overbought and oversold. I think that's kind of a flimsy conceptual architecture because markets can stay overbought and stay oversold for extended periods. So how meaningful is that? I think when you look at divergences in oscillators, they can actually be a lot more powerful because they're telling you from a purely mathematical, arithmetic perspective, in a non-opinion-based sort of way, that momentum behind whatever is happening is fading. And that can be one of two things. Again, it can be consolidation, it can be a turn. But
the market just started to break out here. So in my view, this is not momentum is fading. It's not a divergence here. It's momentum is just reaccelerated.
It's one of two things. It's one of two things. It's either a top or it's a consolidation that's just ended.
Well, I'm playing this like it's a consolidation that just ended at the upside, which is why last week I added more. We had the opportunity, Ilya, looking for the breakout here. I wanted to get a more short delta exposure because it's a 99.4. So buying calls here with the call skew that's in this market, it's still very expensive. I'm just going to go out to 26 days, the July expiry here to make this point right now. But if we were to go into like the 30 delta, okay, for the puts, they're trading around 22.40, so we'll call it 21.40. If we go to the 30 deltas for the calls, okay, maybe this market could be a liquid because it's after hours. But last week, at the end of last week, I swear, there was still call skew here, which is why when you want to express this view, I'm not going to buy expensive calls when the IVRs are up in the high 90s, and I could simply short a put spread where if the technical levels hold and the momentum continues, then those short strikes should never be touched.
Also sell a call spread.
That's just not how not a momentum stuff. Stocks here 75.33.5 in the S&P 500. Are we getting the volatility? Yeah, 32.9, a little bit higher there in the IVR. Vol futures, though, still only up 18 cents. So keep an eye on that here as the night goes along. That has been one of the tells here. Also, crude oil up 2.44%. Ilya, last week when oil was breaking down and stocks are going nuts, one place was conspicuously absent from this as we take a look at the start of trading this week, with gold down another 1.8% here. You've been leaning mostly short, and I have been staying away from it and really either direction for several weeks and months until last week, when on the Fed meeting day, it started to look like gold was getting rejected from 4,400. So I put on just a short outright trade, not through the options, but through the 10Z to join you in a very small, just want to dip my toe in the water kind of thing.
Yeah.
And it's worked out swimmingly here.
Yeah. Gold does not want to go up.
Is this one of the bigger tells for which way the winds are blowing right now? The fact that gold can't seem to find a lick of silver, gold. I mean, they're getting hammered right now, back down towards their yearly lows.
Yeah, and I mean, I think you can see it in the bonds as well, sort of what this is, and in the dollar. Because in all of those things, you get a sense that what the Fed meeting last week meant was a hawkish Fed. That if the question was going to be how in the world is Kevin Warsh going to reconcile the fact that he got sent by the White House to the Fed to be dovish, and you have a situation where that is not the policy decision that most of the board agrees with. The board is clearly very hawkish relative to the White House thinking. And of course, Kevin Warsh himself has a big history of being a hawk. This recent incarnation isn't short-term dovish. And this is, I think, a very important distinction. The argument that Kevin Warsh has put out there for his transformation into rate cuts is we are going to have efficient growth that won't be inflationary. And the reason we're going to do that is AI and technological progress and all of these things. Okay, la-di-da. The problem with that is the inflation issue now presenting itself is not anything that necessarily derails that story or has any impact on it. It's short-term inflation shock that we need to be worried about, and that all of the Fed policymakers are worried about. So what we learned last week is the way that Kevin Warsh is going to thread this needle is say, we are going to have 5, I think, task forces on the various different parts of
that's so stupid.
It's hilarious. It's so stupid. It's management consulting at its worst. So
there's literally the United States of America has an inflation fighting task force called the Federal Open Market Committee.
This is their job.
In fact, on that task force, it's full employment and stable prices.
This is what they do. So we're going to have these 5 task forces.
It's like hiring a plumber. It's like hiring a plumber to manage your house's water, and that guy hires another plumber.
But think about how genius this is from the optics perspective. You had to go and tell the White House, you want me to cut rates. You nominated me to cut rates, but I'm not gonna, because that would be crazy. So what are we going to do? We're going to set up 5 task forces. We're going to give them until the end of the year. So we're going to buy ourselves 6 months to do nothing. And when the president expresses ire, you go, well, the task forces, Mr. President, they're doing their thing. Just give them a second. They're getting there.
Well, the market thinks that Warsh is going to move sooner than that. Ever so quietly, in the second half of last week, the market went to a 39%, 38.48. So we'll round it up to 38.5, which will round up to 39% chance that we get a hike by July, next month, in fact. 97% chance, 98 we'll call it, that we get a hike in September. And then you see by December, there's actually, this could just be a miss, but December, 75% chance of a second hike this year. And then by March, it's all the way up to 98%. So whatever little wrinkle there is in the pricing at the end of the close last week, ignore that for now. But there's a very clear path here. And I think Warsh's stance in the global financial crisis, this isn't his first rodeo with the Fed.
No.
And one of my critiques with Warsh, not that I'm anyone or anything I have to say that matters as it pertains to critique of Federal Reserve officials, but I would encourage people who actually care about this stuff, because he has not been intellectually essentially consistent over the years. Depending upon which party is situated at 1600 Pennsylvania Avenue, he has very clearly taken a view that's consistent with appealing to people that would help promote his career that may or may not be.
The man wanted to be Fed
friends.
chair. He's wanted to be Fed chair for a long time.
And he was hypercritical during the Obama years, and then he was easy during the Trump years, and hypercritical during Biden. So it's very clearly game played. But this is the bigger issue. Forget the politics of it all. Forget the fact that he's the son-in-law of one of Trump's biggest donors. Focus on the fact that he was horribly wrong during the global financial crisis. He was one of the more hawkish voices on the board when Lehman Brothers was going down. He was so concerned with commodity-linked inflation at the time, which, you know, that sounds familiar to where we are right now in the cycle.
It does.
He was so concerned with that, he was overlooking the problems that were going on in the credit market. And when you look at the notes from all the meetings back then, he was of the mind that the market was this great self-correcting mechanism, that there was no reason for the Fed or other institutions to provide liquidity because the markets would handle it themselves. But as history tells us, the models were wrong and liquidity dried up faster than the models ever suggested that they would. So the issue for me right now, Ilya, is the task force perhaps alleviate my concern, which is that Kevin Warsh is a bit of a people pleaser, and so he wants to cut because that's what he's been saying he would do under Trump. But the market is begging for him to hike. And so maybe because of his disposition as a hawk and his promises to Trump and this task force in place, he's going to be prevented from making that too hawkish lean early on in his trajectory because we still have the private credit issues that are going up and cropping up and percolating.
Sure do.
No one's forgotten about Ares or KKR or Blue Owl or all that jazz tied to software and AI and the overvaluations and this, that, the other. And Bitcoin still struggling, although Bitcoin up 1.2% this week, I suppose, is a nice start to things here. But the market telling us right now that July is very much a live meeting.
Yes.
What happens next with oil? If oil's back at 95 at the July meeting versus sitting here at 80 or 75, it's a very different meeting and a very different second half of the year for how the Fed projects inflation.
Yes. And at the end of the day, again, becomes a story about the cost of money. It's not that the Fed being hawkish is going to crash anything per se. It's that the markets just need to go, you know what? We're at record highs. The way we got here most recently has been a very narrow, hype-driven kind of a thing. It's basically semiconductors or bust. This is not, by any stretch, a broad-based rally or anything even remotely close. Why do I want to risk being the person that holds the hot potato if I have to hold it when interest rates are high? If I end up being the last person, and maybe I'm not, but if I am, then I got to take a loss and then I got to borrow back to go again at high interest rates. I don't want to be the person holding the hot potato if getting capital back is going to be expensive. Let me just go ahead and sell it now and then have the capital, have the cash. And then I'm sitting pretty when whatever thing occurs, whatever redistribution occurs. And then I got capital that I can go spend to go shopping for all the same semiconductors and whatever else, but at a very different price point. By the way, that's what I'm thinking. I'm not trying to stay short until the end of time. I'm not betting on Armageddon. I want a discount.
Micron still has a... let me just double check. Maybe it changed on Friday here. I don't want to... No, it still has a 9.7 forward PE. Still pretty cheap, my friend.
Not the most expensive on that basis.
No, and there are other names like SanDisk is up at, I think, at like a 48 right now. Maybe it's changed.
Yeah, but
in TK.
But no, I mean, in your mind, is the next move here going to be decided by valuation or by sentiment? Because in my mind, the answer is clear, and it's sentiment.
One and the same?
I don't think so.
Sentiment is how do you define sentiment? To me, it's like a combination of what's going on in financial media, positioning,
just appetite for risk. I think you're going to get to a point where we've gone so far that people are going to go, you know what? If interest rates aren't going to come down, I don't want risk. I want cash.
Apple warned the world, as the world's largest manufacturer of consumer goods, particularly high-end consumer goods, that its margins are so far under pressure because of the memory chip problem that they can no longer keep the barbarians at the gate, and they need to pass on those price pressures to consumers. Is that not a signal that this thing isn't cyclical like it used to be?
Sure.
Its index was up 11.5% on the news on Friday, Ilya.
Yeah. I mean,
listen, my point here about this is, and I know I'm coming across as smug to a certain extent, although I'm wiped after this weekend, so not as smug as I'd like to be. But if you're a bear and you don't believe in this stuff, it costs you nothing to stand out of the way until this thing actually breaks.
Right. Absolutely. Which is why I think you don't touch the individual names, because they're showing you nothing that, as somebody who looks at this and goes, yeah, la-di-da, doesn't matter. When sentiment breaks, it'll break. Just as it broke in any speculative bubble. Speculative bubbles, let's just make this very clear. The speculative bubble that is, like, say, something like the Dutch tulip mania, based around a nonsense asset, that's rare. Typically, speculative bubbles don't occur around nonsense assets. They typically occur around something that's legitimate, that is a real story, that people really extrapolate for good reasons. The problem is you can't extrapolate things in a straight line because nobody can tell the future that far ahead. And so everybody gets hype, and then everybody gets the rug pulled, and then the long story resumes. It's telecoms, it's railroads, it's the radio, it's the telephone, it's the car, you name it. Steam power, America itself, which was the subject of a speculative bubble early in the start with colonial paper. So the whole thing typically is a real story. So, yeah, you don't bet against it because it can rally in your face, especially given how thin some of these names are. But when you look at the indexes and you go, well, this looks like it's much closer to the top of the range than the bottom, and the risk reward looks good, and we haven't gone anywhere in a month on the big indexes. Clearly, a rally from those lows in April has ended, and we have now started to move sideways. And that's been the story in the NASDAQ. It's been the story in the Russell. It's been the story in the S&P for sure. We haven't gone anywhere on the S&P really since basically mid-May.
The Russell put in 1, 2, 3, 4 of its 5 all-time high closes last week. It's breaking out. It's up 48%.
I mean, look at where we are relative to the June high. Are we?
Yes. Price is higher.
It doesn't look like it.
Oh, you're exhausting.
I mean, look at it. The June 4th high is exactly 3,000. Where are we currently? 2983.
Was last week an all-time high closing week for the Russell?
It was a gap that faded. We gapped over 3,000 and couldn't close above it. So, yeah, intraday we popped a little higher. And
NASDAQ is down by 0.5%.
June 15th, the high was 3,024.
We're ending
Where
this
did we
right
close?
now.
Under.
We're ending this. S&P 7541 down by 0.4% here. Volatility still not really moving up about 20 cents, 16 cents now. Not much of a big pop, not much of a big fade either. Oil still up 2.33%. Micron earnings are Wednesday. You're looking at about a 14% implied move in either direction by the end of this week. We're, of course, going to have live coverage starting tomorrow morning, 8:30 Eastern, 7:30 Central Time with our new revamped morning schedule. Thanks to everyone for sticking around throughout that transition and change. The numbers are good, Ilya. We're getting new audience. We're getting new people. We appreciate our loyal viewers and our new viewers that are sticking around here. So for Ilya Spivak, I'm Chris Vecchio. This has been First Call. You've been watching Tasty Live. Again, tomorrow morning program resumes, 8:30 Eastern, 7:30 Central Time. We'll see you there. Happy Father's Day. Enjoy the rest of the night.
Happy Father's Day, everybody.
We are back. Good morning. You're watching Tasty Live. Jabal, you and I get the co-pilot seats this morning.